The market had a little bit of a sugar high as the Fed released their dot plot map showing their expectations for 3 Fed rate cuts in 2024. In fact, the Dow Jones hit an all-time record high and the bond market dropped more than 0.25% in one day. So if you want to give a pig a pancake, he's going to want syrup to go with it. The market didn't stop at 3. If you actually look at the Fed Watch tool, the market wants 6 Fed rate cuts next year. But are we there yet? That's the question. I want to talk about some of the economics that give me a little bit of pause and where the market is going to go in 2024. But before we do that, make sure to like and subscribe to our channel. Getting this information out to more home buyers just like you helps our channel. So on the first Friday of December for November's numbers, we saw the jobs market increase a positive 199,000 jobs. Now that doesn't sound like a whole lot when you consider the entirety of the United States, but it was increasing over the previous month and showed that the market isn't done fighting for solid jobs yet. We saw wages increase to 4% year over year, which is above the CPI inflation number of 3.2%. Well, increased wages is a good thing. In fact, so good that the Consumer Confidence Index popped up 3% after a 3-month drop. So the consumers are feeling confident. They're getting paid more in wages, and we're continuing to find new jobs. Well, as you can expect, the unemployment numbers that came out the first Friday of December for November's numbers showed that unemployment actually dropped to 3.7%. Typically, you root for this. You want less unemployment as more people find jobs, and that's ultimately what happened. It dropped from 3.9% last month to 3.7%. Not only is this not a good thing when it comes to a slowing economy, but it kind of throws our Psalm rule hint of an upcoming recession out the window, or at least putting it on pause. The Psalm rule is looking at a rolling 3-month average, and we were heading up towards 3.9%, and this kind of put the brakes on that. So if the recession isn't impending and unemployment is dropping and more jobs are actually being created with more pay, not surprising that the consumer confidence is in fact going up. So we had seen mortgage rates drop from 8% to 7%, which was a huge reason to celebrate. But all of this news on the first Friday of December put the rally on pause, and we saw the 30-year fixed mortgage rate stop at 7.1%. Then on December 12th, the CPI inflationary numbers came out, dropping from 3.2% last month to 3.1%. It's a small drop, but all the same showing that long-term inflation is slowing, because month over month it actually increased, but year over year, that small drop on top of, yes, positive, but a softening labor market gave the Fed reason to become dovish. And that's what they did on the 13th of December. In fact, wrapping up their 2-day meeting, Fed Chair Powell came out stating that the economy is normalizing and doesn't need the tight policy. He said we are at or near the peak rate for this cycle. I mean, the market celebrated that. The question had been is, are we going to have another raise in the Fed rate? And he pretty much said no. He also said that overall the development of the labor market has been very positive, that it's a good time for workers to find jobs and get solid wage increases. Now, this is counter to what he had been saying before, where we had to see pain in families and businesses and in the labor market. Now, well, if they're able to find jobs and get solid wage increases, it's a good thing. I guess it is. He also said that the inflation fight isn't over, but the central bank policymakers will start to discuss policy easing and signs of cooling in both inflation and the labor market. Well, all of this set the market to celebrate. As I mentioned earlier, we saw the Dow Jones stock market hit an all-time peak based on this dovish tone. What they were also celebrating was the dot plot map. that had come out showing that they're expecting 3 rate cuts in 2024, 4 rate cuts in 2025, and another 3 rate cuts in 2026. But does the market want for more? It accepted the fact that we're going to have 3 rate cuts, but it put them all before June's Fed meeting. In fact, if you go to the Fed Watch tool, you'll see that not only do they expect 3 rate cuts by June of 2024, they expect 2 to 3 more rate cuts in 2024. And who's they? It's the investors, the market. It's what's rallying and dropping our interest rates and raising the stock market. In fact, not only did the 10-year treasury drop over 0.25%, so did the 30-year fixed mortgage rate from 7.1 to 6.8. Now, that is reason to celebrate, and a lot of people did. But I want to tap the brakes just slightly and state that this exuberance might be overinflated and a little oversugared. Because are we getting too excited about something that hasn't happened yet? So if the Fed is saying that they're going to drop the Fed rate 3 times and the market wants 6, what happens if inflation starts to turn back up again? In fact, the day after the Fed came out with this announcement, retail sales popped up 0.3%, and initial jobless claims dropped to a 2-month low. Those are the kind of market reports that show you that our economy continues to be stronger than expected or maybe desired, and whether or not we're going to have this soft landing. At the end of 2024, a lot of people are forecasting that we're going to see an interest rate between 6.5 and maybe as low as 6.1. Now, we just saw a 0.25% drop in one day, yet we have an entire year for interest rates to drop another, 0.5%, 0.75%, which means it's going to be slow going. It means that there's going to be times where we could see a little drop and we could even see interest rates go back up again. They could be flat for extended periods of time. Ultimately, what I do know is when interest rates drop, mortgage purchase applications jump. In last week alone, we saw a 7.5% increase in mortgage purchase applications. So as I watch this, I want to leave you with a couple of thoughts. One, the market doesn't move in a singular direction. We are going to see volatility, and with that volatility, we can't get as disgruntled as we get exuberant. They come together as a package. And the second thing is that the opportunities to purchase will become tighter as interest rates do drop. We've already seen that where more demand is coming out, and there's a massive amount of the inventory that's locked up behind low interest rates. I mean, 40% of homes don't even have a mortgage, and those that do, 90% are locked in below 6%. Now, we're talking about the fact that the interest rates will be between 6.5 and 6.1% at the end of next year. That's not below 6. So if 90% of the people are locked in below 6, then they don't necessarily have a strong reason to enter the market as a sales or new listing. So that's going to continue to keep inventory tight against increasing demand. All of this to say is find the opportunities not only when they're right for you, when you've got your budget in place, when you are ready to make a move due to life events, or when you see the opportunity that right now demand is still low historically, and it will increase as rates drop. And if you would like, we can absolutely refinance you for free as a special that the Rueth team is doing. Well, that's a wrap for today's market update. There will continue to be more as the market reacts quickly, swiftly, and maybe a little too much for the news that's coming out on a day-to-day basis. So I'd hold back those pancakes and maybe a little of the syrup.